in Q3 of this year, not in the beginning of the year. Okay? And now it looks as though that rally is actually a premature. It wasn't a real rally. And we actually have to go back to the fundamentals. Okay, so what caused the rally? Let's have a look at that. Okay. So let's have a look at what. Okay, I don't have a pointer. Okay. But what happened is that if you look at 2011, it was a terrible year for stocks, mainly because of the US credit downgrade by S&P. But ironically, the US is the best performing market last year. Asia was still terrible. Okay. Now, if you look here, it's actually quite important. If you look at a big crash in the Dow, which is all markets reflected that actually occurred in August. That's when S&P downgraded the US. Now, what caused the recovery? Three things caused the recovery. One, the US economic numbers were better. That was sometime in October. In November, China started to reduce its interest rate. Okay? China reduced its interest rate in November. And in February, we have the first Greek rescue package, which was actually due to fail anyway because you're going to have elections in Greece in April anyway. So these are the three things that caused the rally. So you see the market went up in Singapore, we passed 3,000. Okay, these are the three things again. China reducing interest rate, the Greek rescue. Okay. Okay, so what happened now? What happened now is that if you look at the second column, it actually tells you how the markets rallied this year until until March 15th. So most of the Asian markets go up about 15-20%. Where are we today? We have given up half our gains. So actually the markets are still up for the year. Actually, it's not a bear market, so don't panic. Don't panic. We're just given up half of the gains that we had in the first 2 months of the year. Okay. Now if you look at this, I actually did this again because within 1 day, that was actually yesterday's closing. If I use today's closing, we have lost all the gains. I think we will probably give up all the gains that we had because we weren't supposed to have them. Okay, so what caused the sell-off? One, Greece had a problem. They changed their government. They couldn't honor the loan agreement. They have to have a new election. Second thing that's happening is that China's growth is slowing a lot faster than we thought. So when we thought China would have a soft landing, it could have a hard landing. Okay? The only bright spot in the whole world is the US economy, still doing very well. Okay, now very well. Okay, so this is the key part. This is the most important chart for the bank. Just remember this. This is when we had the first crisis in 2008 caused by the Lehman Brothers collapse. So the VIX index is a risk index, it measures volatility. Normally when things are good, the index is below the 30 level, below 30. When Lehman first happened, it went up to 75. That's when all the stock markets collapsed. Singapore went up 1,004. Okay. Now you look at what happened here in the middle of 2010. The big problem. This is when it first became obvious that Greece, Ireland, Portugal, Spain had some debt problem. So again, the VIX index went up to about 45. So it wasn't as bad as 2008. Then if you look at the second arrow, that happened in August last year. S&P downgrades the US. Again, it went up to 45. Okay, so the key question that we have to answer today is, are we going to go back to 45 or are we going to go back to 75? Okay. If it's 45, then I'll know where to buy. If it's 75, I don't know. Okay. So what happened? Again, we want the VIX itself up at 24. So technically, it's still okay. But I think over the next few days, you will see that the VIX will rise above 30. I think it will go back to the 45 level. Okay? Let's assume that is the correct assumption. That we have a financial crisis, but it's not as bad as 2008. It's similar to the 2010, 2011. Okay? So what is going to cause it to spike up? I think Greece and Spain will default. Let me explain to you why it will default. Okay, that's what I'm saying. These are all the countries that have that problem. Okay? It's not just those few. Okay? And the most dangerous one to me is not Greece, it's actually Italy. Okay? Now, can you see these numbers? Let me explain to you. Okay? If you look at the number here in red, Greece has total debt of 143% of GDP, it's okay. But the absolute figure is very small. It's only 424 billion, nothing. It's almost the same size as Singapore. But look at Italy, the fourth one from the top. They also have total debt to GDP of 120%. So they are very heavily indebted. But the figure is 2.1 trillion. So that is almost 10 times the size of Greece. Okay, so if Italy goes, we have a serious problem. So I think that if we're going to go back when the BRICS is 75, Italy will have to default. But if it's Greece and Spain are more organized, because the numbers are smaller. So what's going to happen? 17th of June, Greece will call another election. Okay? Because the first election they called in May, there was no conclusive government. This is to me a referendum. That is, the people of Greece will decide, do we want to be part of the euro or not? Okay? If they vote in the left are basically the people who say, we don't want the austerity measures. Okay? So if you don't want the austerity measures, you cannot get the light vote of the ECB, the European Bank, or the IMF. Okay? If you don't get the two light votes, Greece will default. Okay? As it stands now, the left are leading with 24% of the vote. So I think that come June 17th, the Greeks will vote in the left-wing government and they will default. Okay? That will actually set the market lower. So I think over the next couple of weeks, the pressure is on the market to go lower. Okay? Starting with a Greek default. Okay? But that's not the end of the problem. Okay? But that's not the end of the problem. Okay? Spain is okay. They had the elections last year, but the unemployment rate in Spain is 25%. But what's more interesting is that those who are under 30 is 50%. So it looks like this is actually throughout Europe we have this very high unemployment figure, which means the countries in Europe cannot do austerity cuts. I'll explain to you later on. But the other interesting risk factor, which is for next year, is that the Germans will have general elections. And I think the current view is that the current Prime Minister will be voted out, which means again more uncertainty in Europe. So Europe is going to be extremely uncertain, cannot solve the problem in the short term. So let me explain to you what the Greek default means. Everyone talks about it, but let me explain what it means. It means that they cannot pay, so they have to write off all their debts. That's okay. I have just owe 400 billion. Somebody. So who is holding the paper? Who is holding the Greek sovereign debt? Okay, the main people who are holding the Greek sovereign debt will be the ECB, which is the European Central Bank, the IMF, and the domestic Greek banks. Okay? So all these others will lose probably half of their assets. The next thing that will happen, Greece will need to issue its own currency. So you've been reading in the newspapers about people taking out their money from the bank. Let's say it's in Singapore. Okay? Let's say you have euros in the bank, you're a Greek citizen, you have euros in the bank. The day Greece says I'm out of the EU, they will freeze your deposit in the bank and issue you the Greek currency. That's why you see there's a rush of people in Greece to take out the euros. Okay? Because if they don't take it out and Greece leaves, they will get Greek currency which they don't want. When the people start taking, there's a run on the banks in Greece, the banks will default because they don't have enough deposits to service their loans. Okay, so I think Greece is a serious problem. Okay, so all that's going to happen is there will be a contagion. Once Greece does it, other countries like Spain and Italy will say, why don't we do the same thing? We don't want to pay our tax, it's too big. Okay, so this is what we are afraid of when we talk about contagion. Now, you recently heard the IMF CEO talking about orderly default. There's no such thing as orderly default. The moment you say, I can't pay, all hell will break loose again. That's why you see that Greece does a run on the banks. Now, we actually have a historic example of what happened. Argentina defaulted in 2002. They had total debt of about 130 billion US dollars. They rolled up everything, the banks collapsed, they issued their own currency. What is it here? What's it? GDP minus 10%. So they started for 1 year. Their currency collapsed. It was actually a flight devaluation. After that, the economy recovered strongly. Let me show you. Look at this. This is GDP growth. So they defaulted, they devalued minus 10%. Then there was a strong period of positive growth. Okay? I think Greece needs to do that. Okay? And also the other countries in Europe. So Europe needs to break up into the strong and weak. This is where Greece is today. GDP about minus 5%. So I would say, what is this default? Minus 10%, devalue of currency, hopefully through exports or recovery in services, our economy can recover. Okay, so why do I think the EU problems are not short-term? One, the national debt levels I showed the chart earlier are very high. The government got no instruments to revive the economy. It's strict almost zero. And if you want to have deficit reduction, it means the government cannot do fiscal expansion. Okay. If you look at Europe, what's interesting is that 50% of GDP is government spending. So if you ask the government to reduce the deficit and spend less, most of the economies in Europe will go into recession. If you go into recession, how can you reduce your debt? Okay, so they're in a very difficult position. I think the only way for them to get out, other than printing money, which is to delay the problem, is actually to devalue the currency. Okay? But they can't do it because it's an amalgamation of many countries. Okay, so what's happening? The government cannot tolerate the deficit reduction because unemployment is so high. And then all the governments are coming up for elections. If they try and impose the deficits like Greece, they will kick out. Okay, so there's a huge mess. It will take many, many years to unwind. Okay, it's almost as bad as Japan. Okay. So what I'm saying is that the bottom line, there will be very bad things will keep popping up now and again from Europe. Okay, so the market will be very volatile. That will be like a roller coaster. Okay? So can you stand the volatility? You cannot. And you should change your investment strategy. Okay, so now back to the strategy. It's going to be volatile. As I said, if you cannot stomach it, please change your strategy. I think you should be into defensive yield plays. Okay? I am 50% in defensive yield plays. Okay, so I'll tell you why I'm going to do that. Okay. One, the global economy is slowing down because Europe is about 12% of the world economy is in recession. We saw very bad results of SIA, LOL, and the commodity companies. Why? Because the global demand is shrinking. So you cannot buy cyclical plays because the economy is weak. Okay, so you should get out of cyclical plays because I think it's going to be bad for at least another year. Okay? Now a lot of people ask me on time. So where is the bottom? I answered I don't know. But I can share with you history. This is where we are now. These are the two support levels I'm looking at. Okay, so what are these two support levels? It's somewhere between 2.5 and 2.6 on the STI index. Provided that the volatility index, the one I told you, is at 45. If it goes up to 75, then you can see that the next supports are much lower. I think 2.2. Okay? So if you have a severe, if you see the VIX shooting up to 70 something, it's not 2.5. It could be 2.2. Okay? So you have to look at the volatility index. You can find it on Bloomberg. So what's our problem? Okay, I'm 55, that's why I took my CPF money, and I don't know what to do with it. Because inflation in Singapore is so damn high, 5%. And you go to the bank, and they only pay you 0.5%. Okay? Are you going to leave your money in CPF and earn 2.4%? You get negative return. Okay? So, I give you some yield stocks to look at. You can go and download with a copy. I give you a whole spectrum, and one of them is actually a perpetual bond. Okay. Now, if you look at it, the yield spreads are for the better companies about 4 to 5%. And if you want to go a little bit further and a little bit more exotic, you can get about 7 to 9%. Okay, so have a look at that. Spread your risk. Put some money in the yield place. Okay. They're actually quite defensive. Now, these are the two bank preference shares. Okay. So they are very similar to the perpetual bonds. There is no guarantee of a dividend, but if the entities pay a dividend to shareholders, they must pay the interest on the bonds first. Okay. Throughout the last 20 years, they've always paid dividend when it's going to bank. That was great. Okay, now let's look at what else we can buy. So 50% dividend. Okay. Next thing is, let's invest in some blue chips. Okay. Don't invest in the penny stock, you would have died if you were invested 3-4 weeks ago. So first, before you start investing in blue chips, you must find out whether stocks are cheap or not. Stocks are actually very cheap. This is the PE of the stock markets around the world. And the red one here is our Singapore market. So the Singapore market is about, for this year, 13 times PE, which is cheap. Now this figure, 9 to 12, means that analysts are expecting corporate earnings in Singapore this year to fall by 20 to 30%. If not, it won't go up. Okay, so this decline in earnings that we are seeing is expected by the analysts already. But if you compare this PE to the PE of the Singapore market over a 10-year period, it's at the low end. Okay, it's 10. So actually the market is cheap. Okay, so what I'm saying is that market is cheap. So when we start by, that's the key question. So this is why I call it a great Singapore sale or great stock sale. Okay, so look carefully. Okay. First of all, you need to look at where did the stock fall to during the two crises that I mentioned, in 2010 and 2011. That will give you a good indication of what levels to start buying. The other thing is that if you want to go slightly smaller, the other investment story that we have seen is that a lot of companies are delisting because the PEs are low. So if you can find some of them, that's also another way to make money. But it's not easy. Okay? So let's look at what happens. Okay. So these are the STI index stocks. I don't know if you can see or not, but go ahead and look at it. What I've done here is I've taken the prices of certain major corrections in the market. Okay, and I compare them to where we are today. Okay, and I've identified 6 or 7 stocks for you to look at. I will quickly go through the stocks here, easier. Okay, these are the levels where you should start looking to buy it. You don't have to rush it today. When the stocks hit that level, you can start accumulating. So for example, I've got 3 financials here, and the stocks are quite close to these levels. Okay, so what happens? When OCBC hits $8, you buy half of what you want to buy. Because you cannot actually pick the bottom. Okay? Because if Greece collapses, OCBC might drop back to $6. So you want to buy all at one shot. When it crosses the threshold, you buy half of what you want to buy. I suspect there will be further downside. You just average out. They're all defensive stocks. They are blue chips. Okay. Look at this. Capital in 176. Okay, so what am I going to say here? That practice is here to stay. It will be a long time. US is the best market, but don't expect QE3 until after the presidential election. Okay, the US presidential election will end, and the new president will take office in February. So if you want QE3, which could be a stimulus for the market, has to be Q2 next year. Okay, so that's what the market is concerned. EU economies are in recession, markets will be volatile, I think until the first half of 2030. Okay. So the key thing is stock market volumes are low. It's the most positive thing that I can find so far. Stock market volumes are low, which means many investors are sitting on the side. So I think you should sit on the side. Come June 70, when the markets have one more sell off, and you start to do some bottom pushing. I think that's about it. Okay, that's it. Now I can take questions. Is there any questions? No? Yes? Okay, the local banks have declared that they don't have much exposure to the European banks. Okay, that's one. The three local banks today are trading at about 1.1, 1.2 times price to book, which is actually very low. Okay? So I think the local banks are fine. The only bank which we don't like is DBS. Okay? And it's not because I don't like DBS per se. I think I don't like the acquisition of the Indonesian entity. I think they are paying too high a price. And historically, whenever they have acquired a bank, whether they acquired Thai Nadu Bank or they acquired Dowhead Bank, they pay too much. Following that, there were a lot of NPLs and provisions. Okay, after they acquired the Indonesian bank, assuming it goes through, DBS will have the highest price to book among all the three banks because they're buying at 2.6 times price to book. Okay, so local banks are not affected, but banks as a whole, if you look at today, there was heavy selling on the banks today, but the banks are always trading, as I said, 1.1, 1.2 times price to book. That's actually very low. Okay. So to me, that's a buying opportunity, but look at the historic levels when the banks sold off, and that will be a good level to come in. That's why I actually gave those levels, where the two Singapore banks, OCBC and UOB, fell to, in 2010 and 2011 as buying levels to look at. Yes?
What are your views about risk? Because they seem to be holding on quite well.
Okay. I have only one REIT in my portfolio here, and that's Capital Mall and Savannah. Okay. I think REITs are okay. Look at the gearing level and look at the kind of businesses that they are in. And to me, the reason why I picked Capital Mall, because I think retail is the most robust of the different property segments in Singapore compared to office or industrial. If the Singapore economy turns down, there will be yield pressure, more yield pressure on office and industrial than on retail. Okay, so I think the REITs are okay. I happen to pick a few that I think if you're prepared to take some risks, Savannah REIT is the highest in Singapore, but it's a Sharia REIT. Okay, and its presentation is not that great, but because of that, you get a 2-3% yield pickup. Any other questions? Yeah.
Do you really think that banana is important for QE3 because actually the banks are actually flush with money, and that's not really? So when QE3 again, it's not going to happen.
I think if you look at the history of the Fed, the only thing they know is to throw money. Okay? And if you look at it, the US has a very high deficit. They already hit the deficit ceiling, so they cannot do fiscal spending. Secondly, they can't cut interest rates any lower. It's already zero. So that's why I think they have no choice. If Bernanke feels that the US economy is impacted by the collapse of Europe, he will have to do QE3. But based on the current economic fundamentals, it doesn't make sense. Okay? But if you look at the spread statement, it's extremely cautious. Because I think the strength of the US recovery is not that broad-based yet. And I don't think Bernanke can do anything to a QE3 until the new president is elected. So to me, QE3, if it's going to be a positive on the market, will only be in second quarter of this year. Yeah.
Can you give us some insight. Why some smaller and medium companies let their share price slide down all the way without seeming to give a damn? Can you give us some insight to what happened to maximizing shareholder value management and all this kind of thing? Thank you.
Well, it's a very tough question. Okay. First of all, the company should engage investors sufficiently that they recognize the value. Right? So I think if you look at it, companies can't do very much. One, if you look at the number of cases in the newspapers recently where the chairman and CEO of the companies have been charged for buying their shares, if they try and support the shares through their own purchases, they might be charged under Section 197, which is creating a false market. Okay, we recently saw it in T International and a few others. Okay. So, what can the companies do? To me, if they can do a share buyback, but they're also limited in terms of the number of percentage they can buy back per day. Okay. So I think I suggested to the companies, if your businesses are doing fine, then why don't you pay more dividends to your shareholders? Because at least you pay and keep them happy while they're waiting for the shares to be re-rated. Okay, so I think if you are an investor, it's in your interest to tell the management that your surplus capital to increase the dividend payout. So at least you get a decent running yield while you're waiting for the share to be re-rated. Anything else? So, yes. I actually recommended it. I think that getting perpetual, the only difference between this issue and the previous ones is that most of the historic perpetuals were issued in tranches of 250,000 for sophisticated investors. Okay. So to me, you have to take a view. Do you believe in the cash flow of Genting International? Answer is probably yes. Okay. The second question you have to ask is, if you believe in the cash flow and the profitability of Genting, it means they can service the debt and pay bond. So your main risk is exit costs and liquidity. So the question is, what is the volume in the Genting perpetual? And how much are you going to buy? That if you are going to buy more than 3 days volume, then I think you shouldn't be buying the perpetual. Because I think your biggest risk is buying perpetuals is probably more the exit costs than anything else, because they are forever. But if you're comfortable with the cash flow of the business, then there's no issue. You actually stand as a preferred creditor over shareholders. Okay, so I'm not that concerned about the Genting perpetual. It's very similar in structure to the bank preference shares. Okay, I think the only reason why the MBS is worried is that they started to offer a retail tranche. Okay, and the MBS is worried that retail investors are not sophisticated enough to know that one, it's forever, there's no redemption, there's a liquidity cost or exit cost if you want to sell, there's no buying. So I think if you are going to hold it for a long time, then I think it doesn't make that much of a difference. Because now it's fallen below par, I think it's quite reasonable. Yes.
What do you think about the hospitality?
Which one is that?
Hospitality.
I don't follow that story.
Then how about, do you think there will be a property bubble that will affect property stocks?
Okay, I think someone asked me this question outside, and I said the reason why property prices haven't fallen, a serious question everyone's asking. And my guess is that the property developers have made a lot of money over the last 3 years. Their balance sheets are very strong. So they are not in a hurry to sell. So if they pay high, they will wait. Okay? But the poor buyers who are speculators, when they get TOP, when there's not enough rental yield to support the purchase, the secondary market will be where you will see the price decline, not the primary market. So I think where we will take. So I think most of those properties will come on stream over the next 2 years. So as you see the TOPs come on stream, you probably see a decline in the secondary, not the primary market. The developers are way too strong. Yes?
Can you talk a bit about gold and why
I don't know anything about gold. You have to ask what farmer, but I think if you look at it, the strong trend in gold has been a hedge against the dollar. Okay? And because global banks were pumping up so much money, and the money and investors were worried about the weak dollar, they all went into gold and other commodities as a hedge against inflation. Okay, so I cannot figure out why, given all this uncertainty, why gold is still weak. Okay, it's around 1,005 something. So I had to look back. I think basically there is a lag effect. Gold will also sell off in line with equities, but then within about 6 weeks of the bottom, gold will actually have a rally as a safe haven. Okay, so I think it could be a buying opportunity, but I'm not a gold expert, I don't know. Okay, but I think if you look at the US economy looks reasonably strong. Okay, and I think that strength in the economy is coming from exports. Okay, and then it's bottomed down. People are actually rebuilding their savings. So that could be that in short term the dollar could be strong. If the dollar is strong, then gold is likely to be relatively weak.
What is your take on commodity stock like solar, silver, gold and battery?
Okay.
Is this
I think the key take on the commodity stocks is what's going to happen to China. Okay, because the reason for the huge boom in the commodity prices was that China was building up huge inventory because they expected their GDP growth to be on a certain level. Okay, now that the Chinese economy is slowing down faster than expected, you actually have to deplete that inventory which you have built up. So I think in the short term, over the next year, you will see the commodity prices will continue to be weak. And you will therefore see that the commodity companies start to report a decline in earnings. Now, the commodity companies, you have to be very careful. There are two parts to their profit. Now, one is the operating profit, which they make from selling their products. And one is the revaluation of biological assets, which is the plants. Okay, so when commodity prices start to decline, they will actually have to downgrade their young seedlings or immature hectares. So you look at the balance sheet properly. There will be two items. So it's always safer to be in the more mature plantation. You don't have a problem about the biological asset evaluation. Okay, but I think commodity stocks are going to be underperform until we see a bottom in the global economy, especially in Europe. Yes.
What do you think of risk in general over the long term?
Sorry, what?
Risk,
Risk.
yeah, in general over the long term. That's the first question. Second question is, what do you think of Hudson Port?
Okay. I don't like REITs per se. The reason is that we buy REITs for the yield, and interest rates are already, I think, at bottom. Okay. If interest rates turn, then the REITs will lose capital value. Okay. So I have preferred to go and buy stocks with a dividend yield. So at least then you have some protection because of the capital value if the earnings improve. Okay, so I don't own any REIT, I own yield stocks. Okay, so I think the REITs are very similar to the bond market. If interest rates turn up because of inflation or any other factor, then I think the REITs will start to underperform by some capital value. Okay. The REITs are also leveraged on capital value. So if capital values fall, the REITs might actually be over leveraged, and you might actually have to issue new shares to bring the gearing down. That's what happened in 2008. Okay. The business side when Hudson Port doesn't have that problem. Okay, Hudson Port today, the key question you have to ask is, when the Chinese economy slows down, will it affect the throughput in the ports in Hong Kong and Shenzhen? Okay, so I think as long as China has positive growth, that shouldn't be the case. Okay, so as long as they have positive throughput, I think they can maintain the yield. Okay, so I think Hudson Port at this level is a good level to look at. Yes. Interesting question. I think the tech sector is going to be surprise you on the upside. Okay, it's a very good view. Last year was a terrible year for the tech sector. Okay? First you have the tsunami. then you have the weak US dollar, then you have the floods in Thailand. So all these three things together, squeeze in margins, the collapse of the supply chain. Okay. So this year, you should see the tech companies report quite strong earnings. Okay. So the question is, why haven't they done so? Okay. The Q1 numbers were actually quite lousy. Okay. So let me give you two figures to look at. One, the global hard disk sector is supposed to grow at about 7% this year. Okay. So recently I went to visit Armstrong. Armstrong actually supplies to the hard disk, really Seagate and Hitachi. Their factories were affected by the flood in Thailand. But by April, output is at the pre-flood level. Okay, so what I'm saying is you will see from Q2 onwards, the tech companies will report quite strong earnings. So what they've done is they come back to where they were before the flood, and then you have the 7% organic growth overall. Okay. So if you want to play hard disk, probably the best stock in the sector will be Broadway. Okay. The other sector which is indicating very strong order book is the semicon equipment sector, because of all the new products that you are having, because of the smartphone and tablets. Okay, so there are a number of companies in the sector you can look at. You can look at AEM, ASTI, you can look at ISDN, Synergy. Okay, they will actually surprise you on the upside. There will be quite strong earnings. So from Q2 onwards, the order book is very strong. Okay, if the US dollar continues to strengthen against the state now, we are seeing they get a double bonus, their margins will improve together with an increase in orders. Okay, all these stocks are also trading at probably 0.4 times price to book, 2-3 times PE. Okay, so if you're lucky, they might even be privatized at NAV, so you might get doubles. Okay, but I think the tech sector is going to have a very good year this year. Any more questions? Yes. Okay, I think property stocks have actually underperformed, really because of government policy. Okay, I think CapitaLand is different. CapitaLand is 40% China property. Okay, so if China basically cuts its interest rate and does significantly the property market, and CapitaLand will do well. I think overall, until our Minister of National Development does something to signal and to stop intervening in the market. Okay, I think what's happening now is that the expectation is that the Minister is not happy that prices haven't fallen. Okay, so he will continue to invoke measures to bring prices down. Okay, as long as that is the perception, it will be very hard for property stocks to perform. Okay, so I'm also not sure whether property companies who have bought land or been land banking at high prices, whether they will have to suffer lower margins if and when property prices start to fall. Okay, so I think it's a sector that will continue to underperform, and I won't actually go into the sector yet until the Minister signals they should stop intervening. And to me, he will only stop intervening when he sees the price decline of 10-15%. Okay, so until then, I think it's only going so soon. Yes. Which company? Capital Talk. Yeah, I like Capital Talk. Yeah, I think if you look at it in the marine space, okay, the rig market is the best market to be in today. Okay, because in terms of global rig utilization, it's more than 90%. Okay, so anybody who is in rig building will do well. Okay, so you have Capital Talk, you have Capital Marine, you even have Baker Tech. But they just pull out the yard. Okay, so the rig segment is very strong. If you look at the second market, which is the offshore vessel market, like someone like Jaya, the charter rates are still very soft, but they have bottomed. Okay, so to me, it's time to start looking at the offshore market. The moment the charter rates start to firm, that's probably when you should start looking at the offshore vessel market. Okay, but other than that, I think the market is going to be quite soft. I think the main problem is that the shipbuilding market, the reason why I haven't talked about the shipbuilding market is that because global charter rates are so soft, a lot of the shipbuilding contracts will be deferred. And a lot of the shipbuilders and financing comes out of Europe. So I'm not even sure whether the bank financing which they have secured will be in place if there is problem with the European banks. Okay? So go into the rig market and check as a second tier the offshore vessel market. Anything else? Yes? Sorry? I think because the global chartering market is going to be tough. Okay? And I think I will see a recovery until next year. Okay, so I think anybody in global chartering, we should stay away until probably 2030. I think it's interesting, a lot of stuff has actually happened at well, it's half price already. But I think there will be no recovery in early, so it's no need to put your money there and then get stuck. Wait for the thing to bottom and turn, then you can start to return to it. Yes. I don't know biosensors, right? Okay. Yes.
What about relative performance in the NTI and the US?
Okay, I think the STI, and you have to remember, is 40% the Singapore banks. So if you look at the STI, it's actually a proxy for the banks. Okay. So I think what's going to happen is that because of the sell-off in the global banks, the concerns about banks having some exposure to each other, the Singapore banks are being sold off together with the global banks. And that's where I think the buying opportunity is, because the local banks have got very little exposure to European lending. Okay. But if the global banks, if the Singapore banks are sold off together with global banks, that would be what will drive the STI index down to 2,000 times the level. Okay, so that will give you the buying opportunity to buy the Singapore banks. I like OCBC, but my analyst likes UOB. Oh yeah, I think if you look at it, the US market has outperformed Asia all of last year. And I told you that the US economic numbers are the best in the because it's driven by domestic and exports. So I think the US probably continues to outperform. Okay. I think the Dow probably finds some support at the 12,000. So the key thing is what is their exposure to Europe. I think nobody knows at the moment. But don't forget that the US market, I have the chart which I had earlier. US market. Okay, if you look at it, the US market is only trading at 12 times PE, and if you look at it, it's one of the few markets where there's actually positive earnings growth compared to Singapore. That's why I think the US market is still undervalued, and most of the US corporates have a lot of cash. Okay. So I think the US corporate America is fine if the government is in trouble. Okay. If they're not like that, thank you very much. Please. Sorry? I think $9 is an interesting level to look at SIA. Okay, because I think there's no PE. SIA's PE is 35 times. Okay, so I think they'll be affected. Okay, but one thing is good. One thing that is in favor of SIA is that crude prices have come up, so fuel costs are going to start to fall. So if I look historically, at about 0.9 times price per book is the bottom for SIA, not PE, forget about PE. And for that price is about $9. I think $9 is a good level to start looking to accumulate SIA. Okay? Thank you very much.
Thank you, Mrs. Scully. We hope you had a beneficial seminar. Have a good weekend.
But I went to see it. Yeah, something. Something a lot of perspective. They go there by